Let me just start first by getting your sense of what you picked up from the much-awaited Jackson Hole speech of Chair Powell. The markets seem to have come away with a view that it's a dovish taper, whatever that means.
So, what matters ultimately for global markets is whether their expectations with respect to the future of policy normalization are getting met or not. And there, to the Fed's credit, this time around, the messaging is very adequately flagged well in advance. And, like you noted, there is a distinction between taper and the actual raising of rates. So the Fed has, in fact, been preparing the market for some sort of a taper to begin. Although timelines on when this begins have been slightly divergent amongst market expectations, but nothing materially. And the Fed chair's speech did not throw any adverse light on this expectation. The big dovish messaging from the Jackson Hole speech was, in fact, this, that there is a very large difference between the taper actually happening, which is linked to substantial further progress on employment and inflation goals. And the chair noted that inflation goals, that progress has been, in fact, made, and the actual liftoff, which is linked to the Fed's assessment of full employment and inflation being at 2% and well on course to modestly exceed 2%. So as of now, that expectation remains intact, that the Fed lifts gradually, and that the peak policy rates in this cycle will be somewhat lower than that in the last cycle.
In terms of sort of the taper process, can you help us with your thinking on how that starts to play out for EMs in terms of capital flows, EMs and then India? What are the determining factors to your mind?
So EMs, as we all understand, are no longer a homogeneous basket. So previous attempts to, basically club them in some sort of a parameterized, constant have actually not worked out. Now, to India's benefit this time around, there are quite a few factors that are noteworthy. Unlike previously, FPIs for debt have actually been quite agnostic of India for the last 3-4 years. So it's not as if they have recently been building a very large position that would be subject to some sort of misfooting. The third aspect is that both at a micro and macro level, there are a lot of levers that India is currently exercising to draw global capital, some of which are fructifying more at micro level. So if you look at company level, both debt and equity as well as FDI kind of money flowing in. And at macro level, hopefully with the disinvestment program now gaining speed and the asset monetization or temporary leasing of asset program also getting underway. So, there is a capital draw that is also in play, although that doesn't take away the primary mandate that current account deficit should be well behaved. And fourthly, the starting point on FX reserves is quite decent, although this is the weakest point in this argument, because for emerging market, it's the flow of FX that would count more, not so much as where you started from.
What, if anything, do you make of sort of the growth differential, story? Because you will have a scenario in which advanced economies will be growing, at a very fast clip, and that sort of growth differential that always brought capital in favor of emerging markets, India, may not be as stark as it has been in the past. Does that play into this future period of taper and normalization of policy from the Fed?
US is the system which has kind of reset the way you analytically think about the world right now, because they've gone ahead and given 25% of GDP as a fiscal stimulus spread over around 1.5-2 years, which has led to a scenario where, over 2021, their growth rate is probably 4 times their long-term trend rate of growth. And over 2022, it will be roughly 2 to 3 times their long-term trend rate of growth, which is quite unprecedented. But if you examine, and this is now quite speculative, but if you examine the US fiscal stimulus in greater detail, bulk of it is a very short period expansion aimed at revenue spending, right? So it is basically some sort of fiscal transfers to households, which by definition has very weak multiplier effects on growth down the line. So in the Indian context, the RBI has put out studies in the past, basically saying that revenue spending has very short multipliers of less than 1 year. Capital spending has stronger multipliers and more persistent multipliers. So if you apply a similar framework to the US economy, most of this spending would probably have very weak growth multipliers. And also a significant portion, as we know now, is getting saved or used for deleveraging, which is amounting to the same thing by households. What in other words and more simply it means is that at least to us, there is a reasonable probability that by 2000, late 22, early 23, the US system would have probably run out of a substantial portion of this fiscal fuel. Now, obviously, on the other side, you may argue that fresh stimulus is being talked about, which is now aimed at infrastructure and therefore will have stronger growth multipliers. But to be fair, those are being planned over longer periods of time. And the net stimulus spending there is weaker because a lot of that will be financed by the budget, through some other measures. So, although today the growth rates of the developed world seem overwhelming, we are cognizant that a lot of it comes through a short burst of very large fiscal spending, which probably has lower growth multipliers. And the situation, let's say in 2023, may look quite different.
There was real worry of rising US yields, what that could mean in terms of sort of implied tightening for economies before they were ready for it. That has, in a sort of counterintuitive way, eased off as we get perhaps closer to taper. What's your thinking on that and how that moves forward, and also then the implications for the dollar?
If you see how much rate hike expectations people are building, let's say in 2023, that has stagnated to fallen, and then it kind of bounces around a particular point. If you see bond yields, they seem to have peaked out over there. Probably it has to do with, one, the forward discounting mechanism of the market, and second, because data itself has started to turn out slightly more mixed compared to the elevated expectations of the market. So it's always about, actual versus expectation. And market had very, very lofty expectations with respect to US data. And, recent data has been more patchy and mixed. That is not to say that we cannot have another reset shock, right? And like I said before, if there is one tail risk that we worry about, it is that probably a mix of data reopening or inflation persistence for a period of time leads market to believe that the peak rates in this cycle are probably going to be higher than what is being discounted currently.
Are there policy mistakes that either on, not so much on their side, but on our side, which could sort of precipitate a worse experience of a taper tantrum this time around than we have seen or than we are anticipating right now?
One question on market's mind is that you have core liquidity in the vicinity of 11 lakh crores. So how will your normalization run? Will it be just expansion of VRRR in quantum as well as tenure? And then you can at some juncture start to hike the reverse repo rate, or you are going to take durable steps to remove liquidity. Obviously, nobody expects OMO sales to the market, but something like MSS bonds or something like that. So the question really in markets mind or in RBI's mind to us would be that when the next step is taken, there is a risk that market overreads that, and therefore one has to lay out that framework well in advance. And the other point, that is 335 overstaying its welcome in some sense? Because remember, I mean, a bank is raising money at 385, 390 for 1 year today. Housing finance and non-bank finance companies are raising at 430. Now, reasonably, whether that amount of accommodation for such balance sheets is required or not is something that one can always argue for. So we are in the realm of nuance. Right. And obviously, policy needs to continue to be accommodative. Obviously, we need to gently flatten the yield curve as the overnight rate starts to rise. And for those things to happen, a schedule or an analytical framework of how normalization would proceed is probably something that the RBI should now start to think about to manage the signaling effect of whenever the next step is taken.